Hello everyone. I thought I would make a quick video to help you get started on the bydesign practice set. Now basically what we're going to do in the bydesign practice set is we're going to go through the entire accounting cycle. And what I'll focus on in this video is what you need to do for the first submission. Now for the first submission, you're going to journalize the transactions, you're going to post them to the ledger, and you're going to prepare an unadjusted trial balance. And then for the second submission, you'll do your adjustments, you'll make your financial statements, you'll do your closing. It'll be beautiful. Now, I'm sitting here in my living room doing this in Shawnigan Lake. I have a dozen chickens and 2 roosters outside the window, so if you hear a crowing noise, that's what it is, and I'm going to keep going. Unless I mess up, and then I'll start again, and you'll never know about it. So, we're the accountants. Our client is Joe McDonald, who's a sole proprietor and owner of bydesign, a new web design company. Several months ago, Joe completed a certificate in web design as well as business courses at Camosun, which combined well with Joe's background in IT and graphics. Bydesign began operations last month with an initial cash investment by Joe of $4,000 and a contribution of office equipment worth $850. I'll stop there. It's that contribution of office equipment is one of the most common mistakes when you're doing this by design. So it is a contribution of capital, but rather than cash, it's going to be a contribution of an asset. So owner's equity or capital on one side and the asset on the other. Joe rents a small studio downtown that receives a good flow through of street traffic. Bydesign offers 2 main services, web design and website maintenance. Joe has hired your small accounting firm, Interurban Accountants, to record the transactions of the first month of business and to compile financial statements for the first month, excluding cash flow statement. You can go crazy, pick whatever first month you want, but when you look at the transactions, you'll see that there's 31 days, so pick a month with 31 days. It can be October, it can be December. Go crazy, make it January or March if you want. Now, let's look at the instructions, because they're good instructions. So there's different source documents there, and I'm going to kind of go through them with you in a bit. So there's deposit slips, and those are deposits that you make to the bank. There's daily cash summary sheets, which are summary sheets from the cash register. And there's check stubs. So when you write checks to pay bills in a business, it's part of your record keeping system. When you tear off your check, there's a stub there and you write all the information on the stub. It's kind of old school, but it's still done. There's some invoices we get. Now, before we start anything, make sure that you have all the source documents. So all the stuff that I just skipped over, look at them and make sure that they're all there. It talks about a bank statement, and I'll give you the bank statement after you submit the first assignment for the second part of it. Read all the instructions before recording any transactions. Now, I may not do that because I want to help you get started. And I may curse myself and have to go back and start all over again. Now, some things we need to know. Any printed material you get is considered an office supply. So there'll be some questions. You're going to get some business cards. What are they? Well, that tells you. And this is important. So accounting can be frustrating when you're preparing the statements if they don't balance. And what this says is you're better just to leave them not balancing. Don't try and fix them by introducing some other error somewhere in your statements, because I happen to be an auditor in another life, and that's the kind of stuff that I find. So it's way worse on you if you try and hide something than if you just say, I couldn't find it. It didn't work. Use the chart of accounts, so that's going to help us number the accounts. The first 2 accounts have been set up already, and I've gone in and set up some of the accounts because the more stuff I do while I'm on this computer, the more mistakes I'll make. It says record in the general journal in chronological order the accounting entries for the first month of operations. So step number 1 says what you're going to do is break out your scissors. You're going to take all the pieces of information that you have, you'll cut them into individual pieces, and you'll put them in chronological order. And then you'll see how things happen. What it's saying is that there's some things that happen right away. And the example that they give is your business license from the District of Saanich. You walked in and you wrote a check and got your business license right away. So when you look at that, you'll see a receipt from Saanich for your business license, and you'll see a check on the same day. Whereas when you buy your computer equipment, you're going to go in, you'll buy your computer equipment, and they're going to put that on account for you. So you're going to get a bill for your computer equipment, and you've got 30 days to pay. That's going to go on an accounts payable, and when you actually pay it, you'll reverse the accounts payable and reduce your cash. But for something like the District of Saanich, where you pay on the same day, you don't have to set up a payable. That's what I'm trying to say. The other thing that's a little different is GST, and we'll do one GST example together while we're here and talk about it. PST is weird too. So get everything in order, because your journal entries are supposed to be in chronological order, and you might dig through and find this, and oh no, it should have gone there. And even on the computer, it's kind of a pain to fix it afterward. Not as much of a pain if it's manual. Speaking of which, I'm going to do this on the computer template. You're welcome to use the computer template. If you've downloaded it already, I've deleted the 2 subsidiary ledgers. You're not responsible for those. You can do them on the manual forms and scan the manual forms in if you like. That's perfectly fine. So there's the chart of accounts. It tells us the category of accounts, whether they're current assets, capital assets, current liabilities. We don't have any long-term liabilities yet. Owner's equity, revenues, or expenses. So we'll set up those accounts. And as you set them up, think about whether they should have a debit balance or a credit balance. And I'll talk about that with a few examples that I do. Now let's go through and look at these things. These are deposits. So you would go to the bank and you would write up these deposit slips, and it would be money going into the bank. This money should appear elsewhere in your financial statement, so you shouldn't actually have to enter this money directly into the bank. So this first $4,000 going in, you would have already made the transaction, because that would have been Joe McDonald's contribution of capital. And you'll see when you go through, you'll find this number. It's from the daily cash sales. So there's. And we did set up some accounts receivable. So one of the reasons that we have to put these in order is that you're going to set one up for Scott and Hoggard. And here it shows that they paid. So you'll have a day that you made the deposit, and this deposit was paid. So now you've got cash, but you're reducing your accounts receivable because they've paid their accounts receivable. So as you go through these, most of them will be a confirmation of other transactions, but this one, Scott and Hoggard, will actually be a new transaction because it's telling you that they paid their invoice. Now here's an invoice that you made to Scott and Hoggard, and we'll actually put this one in for the first time. So initially it would go in as revenue, and it would go in, we'd have to deal with the GST, and we'll talk about how to do that. And then when they paid you, wouldn't be revenue again, but cash would be coming in, and we'd reverse our accounts receivable. Okay, another invoice by us, more invoices by us. And what this is twice a month you cash out. Sometimes you cash out every day. But when you cash out, you get a summary from your cash register, and it tells you the people that came into your shop, what they did, and it basically is giving you your cash sales. So you can look and agree those numbers to the deposits we looked at. So these and the deposits kind of make up one transaction. So these are revenues and they're cash. These are the checks you've written, and we talked about the District of Saanich one. Gives you the amount of the check, gives you the date of the check. For things that you're paying for, you would probably have to set them up as an accounts payable, and then when you paid them, you reverse your accounts payable, but you'd also decrease your cash. So you want to cut out these checks and match them to what they're paying. And then we've got things that we buy. These are our accounts payable: Computer Depot, Computer Supply World, District of Saanich. But remember, that was the one that would go instantly to an expense. We wouldn't have to set that up as a payable because it was paid instantly. Gordon Head Property Management, that's for paying our rent. an insurance invoice, and it's a 3-month, so that tells you what you're going to do with that in terms of setting it up. TELUS, setting up our phone line, and the print shop. Okay, let's go and do a transaction, maybe two. And as we do them, we'll talk about how to set them up. So the first thing is that Joe McDonald, on the first day of the month, and I'm going to use October, she contributed $4,000 in cash and $850 in office equipment. So I'm going to go to my spreadsheet. I'm going to go to my general journal, and the first day is October the 1st. And I'm going to put my debit entries first, and I know cash is going to increase. And I know office equipment is going to increase. And the other side of this is going to be Joe McDonald, easy for me to spell, capital. So where it says reference, that's the ledger account I'm going to post it to, and it's right there. It's brilliant. Couldn't be more convenient. Office equipment, where is office equipment under capital assets? It's $1,055, and her capital account is $3,010. So cash was $4,000, office equipment was $850, and capital is going to be both of those. And I'm just going to add them up together, and then I won't make a mistake. So now I can go into the general ledger and I can do these postings. So the first one is cash. So we go to our accounts, and here's cash. So we put in October 1, and we've contributed cash, so contribution by owner. And the reference is the page of the journal. I'm only going to have one page, and I'm going to go and click on this in my journal. 4,000, beautiful. And my balance is going to be 4,000. Now, when I get to the next month, I'm going to click on my balance. I'm going to add debits, and I'm going to subtract credits. And what this will do is it'll keep a running total in the balance column. So if I keep copying that down, when I look in the balance column at any one time, I should be able to know what the balance is in my account at that time. So the other thing that we contributed to was office equipment. So let's go down, down, down. There it is, office equipment. And on October 1, I'm going to put owner contribution of office equipment. Happened on the first page of my journal, so I'm going to put in J1. It's an asset too, so remember assets have a debit balance, so I'm going to debit. It has to be consistent with your journal. So there's my balance, and once again, well, I'll show you when we get to a different account. Now the other side of this, our credit side, and remember for each transaction, debits and credits have to match, is our capital. So this is October 1, and it's contribution of cash and office equipment. If you did this as two journal entries, it would not be wrong. So this time it's a credit. I'm going to go up to my general journal, and I'm going to hit credit. Now, this is an owner's equity account, and it should have a credit balance. So what I'm going to do on the next one is I'm going to hit balance, I'm going to add credits, and I'm going to subtract debits, and that's how I'm going to get my balance as I go down. Once again, when I look at this at any point in time, I should be able to know what my balance is. Now, let's look at something that's got GST in it, because GST is discussed in the book, but it's kind of hidden away. So I'm going to do the transaction here, even though I shouldn't, because there's going to be a lot of transactions in between. Let's go and find something, a likely candidate. Down, 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 not that one, 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 not that one. Oh, 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 oh. Okay, so here's a good one. Our purchase from the computer depot, so we're buying computer equipment. Now, if you look at it, there's the price, $22.50. There's GST and there's PST, $157.50. GST we actually set up two accounts for. We set up an asset account, GST paid, and that asset account is all the GST we pay out. We set out a liability account called GST collected, and that's all the GST we collect on our services. Now, the reason we set up the GST accounts like this is once a quarter, if we're a big enough company, we have to go to the Canada Revenue Agency and we have to reconcile our GST. It's something called a value-added tax. What they do is they say, okay, give us a check for all the GST you collected for us, but we'll let you offset that with all the GST that you paid. So the GST that you pay is an asset because you get to use that to reduce the check that you write to the Canada Revenue Agency. PST, remember the big hullabaloo about the PST and when they harmonized it? Well, the PST isn't a value-added tax. It's usually just borne by the business. So even though we pay PST, what we're going to do with our PST is not quite ignore it, but we're going to take that PST number and we're going to add it to the price of the computer. Okay, so we'll flip back and forth to this and we'll have to do some math. But basically, we're setting this one up as an accounts payable. That's going to be our credit. We're going to have two assets. We're going to have computer equipment and we're going to have GST. Actually, this will work. Okay, so I need the date. I go back, and the date is the 2nd. So October 2nd. And I bought myself some computer equipment. There we go. Now, computer equipment is account 1065, so I'm going to put that down now. And I've got to go back and look and see how much computer equipment I bought. Okay, so I bought $22.50. Plus, I actually have to add to that the PST. And the PST is $157.50. 157.50. So there, I actually have computer equipment for $2407.50. Then I have this other asset that I was telling you about, and that's GST paid on purchases. And that's account number 1020, an asset account. So I'm going to set that up as GST paid on purchases, and I'm going to go and I'm going to find the amount. And the amount is $25.20. No, it isn't. The amount is $112.50. And the other side of this is all going to be set up as an accounts payable. So my accounts payable is 2010, and that's going to be for the whole amount. And if everything goes well, that will actually be this amount. So let me just go check my invoice amount, 2520, 2520, yes! Okay, I'm not going to post this to the general ledger because I have great faith that you can do that, but that gives an example of how you deal with GST paid on purchases. Now, when it's your invoice and you're charging the customer GST, then that becomes a liability account, GST charged on sales, and it will show up, of course, as all liability accounts do, with a credit balance. Okay, so hopefully this will help you get started. Please use the discussion page if you have more questions.